This is the most expensive software stock on earth. Palantir trades at over 40 times its sales. The average enterprise software company trades at about 7. You are paying 6 times the going rate for every dollar of revenue. And yet last quarter this company grew 85%, the fastest in its history, at a 60% operating margin. So which is it, the best business in software, or the most dangerous bubble in the market? The whole debate comes down to one machine they call the Flywheel, the AIP platform, built on something called an ontology, now spinning inside both Fortune 500 boardrooms and NATO's battlefield. Let's run the numbers. Start with what this company actually does, because most people have no idea. Palantir builds operational software, systems that don't just show you data, they help you act on it. 4 pieces: Gotham for defense, Foundry for enterprises, Apollo to deploy it all, and AIP, the artificial intelligence platform, which wires large language models into everything. The simplest way to say it, most tools build dashboards so a human can read the data and decide. Palantir builds the layer where the decision gets made and executed, rerouting a supply chain, retargeting a sensor, reworking a hospital's patient flow. It is not a chart. It is the operating system underneath the chart. Now the moat, and it comes down to one strange, early bet. Years ago, Palantir wired its whole platform to an ontology, a structured world model that represents data the way humans reason, name things, the relationships between them, the rules for how they interact. At the time that looked eccentric. Everyone else optimized for speed, data into tables, run queries fast, ship dashboards. Palantir built a slower, richer model of the world instead. Then large language models arrived, and that ontology suddenly looked like genius, because an AI model wants exactly that, a structured, language-shaped map of named entities and relationships to act on. The thing that looked like a liability for a decade became the perfect surface for AI. That is the wedge no rival has copied at scale. So how does the moat turn into money? Through a sales motion almost no software company uses. Palantir runs AIP bootcamps, multi-day workshops where a customer plugs in their own data and builds a working use case in days, not quarters. The conversion is the story. A Fortune 100 retailer turned a pilot into a $12 million contract within months. Industrial accounts expand roughly 5 times off their first engagement. That is the flywheel: get in fast, prove value on real data, expand across the enterprise. And it shows up directly. U.S. commercial revenue grew 133% last quarter, and commercial customers reached 1,007, up 31% in a year. The land and expand engine is running hot. So how big is the blowout? Let's put the quarter on the table. Total revenue, $1.6 billion, up 85% year over year, the highest growth rate Palantir has ever printed. U.S. revenue alone grew 104%, crossing the 100% line for the first time. Then management raised guidance hard. Full year 2026 revenue is now guided near $7.65 billion, about 71% growth. U.S. commercial alone is guided above $3.2 billion, up 120%. And remaining contracted revenue more than doubled, to $4.45 billion. For a company already this size, these are not normal software numbers. This is acceleration where most companies decelerate. If you're tracking the AI stack from the top, subscribe. Next up is the company at the bottom of it, Micron, the only US name in the memory shortage. Now the half of Palantir that built it, and that Wall Street keeps underrating. Before the commercial boom, Palantir was a defense company, and it still is. US government revenue grew 84% last quarter, to $687 million. And the contracts are sticky. NATO sole-sourced Palantir's Maven smart system, its AI for battlefield operations, meaning no competitive bid. Maven is set to become an official US program of record by September, turning it into a multi-year annuity. Palantir is also on the Army's next-gen command and control program with Anduril. But here's the honest caveat the bulls skip: an Army review flagged that command and control system very high risk on security. Government revenue is durable, but it is not frictionless. Here's the part that separates this from every other hypergrowth story. Most companies growing 85% are burning cash to do it. Palantir is doing the opposite: it is wildly profitable. In the fourth quarter, reported net income was $609 million, up from $79 million a year earlier. For the full year, net income landed near $1.6 billion. And the cleanest measure of all, the Rule of 40, revenue growth plus margin, where 40 is elite, hit 127%. Let that sit. The bar is 40. Palantir printed 127. Almost no software company at this scale grows and earns like this at once. That, not the hype, is what the premium is supposedly paying for. So who can actually take this business? Let's lay out the field. The real rivals are the data analysis platforms, Databricks, Snowflake, Microsoft Fabric, and C3.ai. In defense, Anduril, Booz Allen, and Leidos. Then the dashboards, Tableau, Power BI, Qlik, and the government IT primes. The benchmark to respect is Databricks, privately held, more than 20,000 customers, over 60% of the Fortune 500, a $5.4 billion run rate growing 65%. But here's the distinction. Snowflake and Databricks optimized for analytics, getting data into tables and querying it fast. Palantir optimized for the operational decision on top of the ontology. No single rival offers the full stack, ontology, pipelines, AI orchestration, and government accreditation, in one place. That gap is the bull case. Now the number everyone argues about. Palantir is worth roughly $280 billion, near $116 a share. It trades at about 74 times forward earnings and more than 40 times sales, the richest large-cap software multiple on the market. So why pay it? Because the bull extrapolates, 85% growth, a flywheel still igniting, a government annuity, and margins most software firms never reach. But the market is having second thoughts. The stock is down about 34% this year, a quarter of that just in June. That sell-off isn't the business breaking, it's the market repricing the multiple. At 40 times sales, you pay today for nearly a decade of flawless execution. The quality is real. The price is the whole question. Let's put it together. On one side, the fastest growth in the company's history at 85%, US commercial up 133%, a 60% operating margin, a Rule of 40 at 127, a sole-sourced NATO annuity, and an ontology moat no rival has matched. On the other side, a multiple above 40 times sales that prices in years of perfection, a stock already down 34% this year, hardening growth comparisons, and a very high risk flag on its flagship Army program. The franchise says exceptional. The valuation says you'd better be right. Both can be true at once, which is exactly why this stock moves the way it does. So where do I land? In my view, Palantir is a genuinely rare business. The Ontology Bet aged into a real moat, the AIP flywheel is clearly working, and profitability at this growth rate is almost unheard of. This is not a story stock with no substance. The substance is there. But the price demands perfection. 40 times sales leaves zero room for a single disappointing quarter, and the 34% drop this year is the market reminding everyone how fast a premium multiple compresses. I'd want to own this franchise. I just want the growth to keep outrunning the expectations baked into it. At this multiple, the bar gets higher every quarter, not lower. The business is exceptional. The entry price decides your return. My base case for the next 12 to 18 months, the commercial flywheel keeps spinning, government converts to multi-year programs, profitability stays elite, and the stock trades on whether growth beats a demanding multiple. Watch 4 signals. First, US commercial growth. 133% last quarter, guided above 120 for the year. A slip below roughly 80% is the first crack. Second, customers and backlog. 1,007 commercial customers, $4.45 billion in remaining contract value. Net new logos prove the Bootcamp engine, a stall is the tell. Third, the Rule of 40, at 127. As long as it stays far above 40, the premium has an argument. Fourth, government conversions, NATO Maven, the program of record transition, and whether the Army's risk flags clear. Upstream, Palantir depends on cloud compute and frontier models. Downstream, it sits inside enterprises and militaries making real decisions. The catalyst that lifts it, the flywheel outrunning the multiple. The one that breaks it, any quarter that doesn't. Palantir is the most expensive software stock on the market, over 40 times sales, and it just grew 85%, its fastest ever, at a 60% margin. The moat is an ontology that turned from an odd bet into the perfect surface for AI. The flywheel is AIP bootcamps converting pilots into 8-figure deals. The ballast is a sole-sourced NATO annuity and a rule of 40 at 127. The catch is the price, a multiple that already assumes a decade of perfection, and a stock down 34% this year as the market tests that assumption. The bull case is the best flywheel in software. The bear case is the math you pay to own it. One stock, all the numbers, no hype. I'm Big Z, follow me, see you in the next deep dive.